Happy 2022 to all of you. Welcome to the new year. I wanted to start this year with a review of the current media. I want to chat about some of the things that I'm seeing in the market and stuff that we're considering at Wealthi. Last year was a tremendous year. Let's have a look at some of that. Like over a 12-month period, nationally, the market grew by 22%. So, let's put that into context. If you had bought a $500,000 asset and it has grown by 22%, it's now worth $610,000. You would have made $100,000. And if you bought $1 million property, you would have made $200K. That is a very, very good market, a very strong market. Now, I do want to say, don't expect this every single year or even expect it this year. I think that the next 12 months will be very interesting. There are a lot of key themes that are coming out. Now, many of the economists, reporters, industry leaders are saying that this year will be slower, that we could expect a more modest growth. The tagline has been maybe have 5 to 10% growth over 12 months, and then the following year there may be some price declines. What I really want to pay attention to this year is income growth. I want to be looking at inflation and then interest rates, where they're going to go and what that means. I also want to talk about migration. I want to talk about tourism, students. I want to talk about population growth. Now, in real estate, I think it's vitally important to keep your head on your shoulders and remember this is a long-term investment. Some of you out there are developers and property flippers and effectively traders of real estate. Now, it's a very different scenario for you. You're benefited by the market's growth, but you're not dependent upon it. When you're more of a long-term real estate player, when you're looking to buy and hold, certainly market movements matter because it helps you. But you want to look at the bigger themes. Now, this is an interesting article that was done by the Urban Developer. It basically canvassed a lot of the industry experts, property developers, landowners, and there were some really key themes that were highlighted to me. Some of the stuff that popped out is a lot of people are still bullish on the market. They still think that there's going to be strong demand in real estate for houses, townhouses, and apartments. One thing that is abundantly clear, they all believe that when international borders reopen, this is going to have a massive impact on rental levels, particularly when migration starts back up. This is something that we've discussed many, many times in the past. Another thing that is abundantly clear is that building costs are going up. It's costing much, much more to get a piece of real estate out of the dirt. One thing that has been interesting is a lot of people are looking to jump into build to rent. So property developers, the people that used to buy properties, cut it up and then sell it, are now seeing more and more value in buying a property, buying a block of land, cutting it up, making 100 units, and then potentially keeping 50% of them, maybe even all of them. Now, you have to say, why are developers making this shift to owning the real estate rather than selling it? One person that was a standout to me is this gentleman here, Tim Gurner. He is a property developer, and he's saying here, build to rent will be a big focus for us. Over the next 5 years, I see 40 to 50% of our business being in that, or being in build to rent. So, that's something to consider. Why are all these developers looking to then hold on to more of the real estate? Something else that is pretty interesting is that there is a consensus in that they believe rising mortgage rates will squeeze affordability, and then there will be more tightening from APRA for the lending regulations. So that will have a softening effect on the growth of real estate. Um, that to me has been pretty interesting. They believe that the next 12 months it will be still quite positive. And then, yeah, that's really been the focus, that there's going to be a shift to mill to rent, that the property market will stay strong. You're going to have to keep your head on your shoulders and really watch for where building costs are going to go up. And we want to be paying attention to migration and where people are going to go. Population growth is likely to be a government focus. And they're going to achieve this by bolstering the migration intake. Very, very interesting to me. Now, another thing to sort of pay attention to here is inflation. So in the US, inflation has surged 7%. This has a trade-on effect for them. They're going to start increasing their interest rates very soon. And that will mean that shortly after, in Australia, we're going to be increasing our interest rates. Now, I want to point to an article that my business partner, Peter Esho, actually wrote. What really happens to real estate when interest rates start rising? Now, one thing that I found particularly interesting is, look, it's both good and bad news. Interest rates rising, it impacts the property market, particularly if you're a home owner. Homeowners don't have the luxury of collecting rent. It's when interest rates rise, it means they've just got to pay more money out of their pocket. Some homeowners out there may find themselves in a distress or in a difficult situation where it'll be harder for them to repay their mortgage. Though I think for the vast majority of homeowners out there, they're going to be okay because of two things. One, wages are going up, and two, our banking regulation is very, very tight. They don't just let anyone go and get a mortgage. They stress test it at 6 or 7%. And they're typically lending out that money at 3%. So there is a wide buffer when they are stress testing these rates. Now, what Peter likes to talk about here is he's following some of the commentary from Blackstone. Blackstone is one of the largest, if not the largest, investors, the traders in the world. And what they've pointed to here is historically, private real estate income has generally increased faster than inflation. Growth in real estate income was driven by a number of factors, including market rent and rent escalation clauses. Basically saying that private real estate typically has gone up in value in an environment where interest rates have gone up. Here we go. US private real estate values generally have increased during periods of rising interest rates. Now, I'm pointing all of this out to you to say that, yes, interest rates are going to go up at some point in time, but it's not going to be as dire as everybody believes, that a small rise in interest rates will then lead to a collapse in the property market. Where in fact, data to that has been quite contrarian, where property prices have gone up in the private sector. Now, another thing to be paying attention to is if you are a real estate investor, rising interest rates, rising inflation, and then rising interest rates typically does lead to a rise in rent. And it's typically a bit more, the rise in rent is more than inflation. So it's probably good news for you as a real estate investor. Now, there are some parts of the market that will see rises in rents faster than others. This is an interesting article here that we are starting to see nationally, median weekly rental advertised rates have increased by 4.7% over 3 months to December, and a surge of 4.7% year on year. Now, this hasn't been everywhere equally. Some markets have gone down a little bit, particularly in the Melbourne metro market, but the markets that have grown the most have been regional, people coming out of the CBDs going into regional centres. But what we want to have a look at is the longer term. And this is something to pay attention to here. Now, the borders have recently opened up here, and the government is looking to relax some of its, allowing people into the country, but relax some of the visa rules. Up to 400,000 foreign students will be able to work at extra hours under the temporary relaxation of visa rules to ease crippling labour shortages. Now, this is telling me something here. One, they want to allow students to work more, giving them higher disposable incomes whilst they're here. But two, the government is starting to look at allowing more people into the country. And if that starts to happen, we're going to see two things. The major metro markets start to spike because they will capture the vast majority of migrants. And we're going to see a lot more people come in and push up the rents. Higher disposable income amongst the students will mean they can spend more money on rent in major metropolitan hubs. And then also, when borders open up, tourists come back in on Airbnb, on stays, all of that. They take a lot of the properties out of the market, particularly apartments, also houses. But them taking properties out of the market means less supply and then upward inflation, upward pricing for the rents as well. Now, another thing that I want to be paying attention to is population growth across capital cities. This has come from the government website. And here it is saying that something to be paying attention to is the Melbourne market. Not that one there. Here we are, Melbourne. So Melbourne is actually planning to outstrip Sydney's population by about 2028. So in the next 6 years, the population of Melbourne will outstrip Sydney. Now, I think that's interesting because if you have a look at where property prices have grown the least, it has been, out of the major metro hubs, it has been Melbourne. So Sydney's performed quite well, Brisbane has performed quite well, Canberra's performed quite well, Hobart has, Adelaide has as well. Perth hasn't done so well, Darwin hasn't, but the one that I want to pay attention to is Melbourne. Now, the reason why I'm saying all of this is I do think that there are some good opportunities for Melbourne apartments, Melbourne townhouses over the next 12 to 24 months. So looking at the larger cyclical patterns that are happening at the moment, migration will open back up, tourism will come back, students will come back, increases in rents will eventually start to happen, and with interest rates increasing over time due to inflation, people's ability to buy properties will decrease. They're not going to be able to spend $1 million anymore. They're going to spend $600,000 or $700,000. So I do think there is a massive opportunity in the next 12 to 24 months to buy smaller, affordable properties, either go into the fringes or buy something smaller, apartments or townhouses. So there's a lot to digest there. I think that there are a lot of interesting articles which I will share in here. I'll do these pieces to review the market, talk about the different things that are happening in the press, give my impressions of that, and happy investing this year. There's lots of different opportunities out there. I think we need to be a bit counter-cyclical. Don't just follow the markets that have run the hardest. You're going to need a lot of bravery to invest in some of these parts of the market, but it really is about thinking about 3, 5, and the 7-year time horizons, which will help us the most. Anyways, if you've got any questions, let me know. Leave them in the comments below. Otherwise, I'll see you next week.